Okay, so let's now look at our True Potential strategy and wealth strategy fund range. And before I do that, I'd just like to say that we're incredibly pleased to have launched a new True Potential fund, and that's in partnership with UBS. These funds are low cost, they're innovative, and they're from one of the most respected wealth managers in the world right now. So next time, I'll be able to give you an update on their investment outlook and exactly what's been happening within their funds. Okay, so let's move on to our funds right now. I'm going to start off with Schroders. So the main change to the Schroder fund range is that they've been increasing their weighting into commodities. They've been doing that by buying gold equities through BlackRock Gold in general. So Schroders, they're very much cognizant of what's been happening with the gold price. Obviously, the gold price has had an extremely good run. However, it's very, very far away from its 2011 high. Schroders, looking at income, they are quite nervous around valuations in bond markets. They do feel that bond markets are overvalued at the moment. And they're now looking to more sort of non-traditional areas of income investment, and that's things such as US high yield and emerging market debt. So let's move on to SCI. Although SCI do feel that equity valuations look rich, particularly within higher quality stocks, they still feel that there are a lot of opportunities out there. SCI feel that governments will be very accommodating when it comes to interest rates, and they won't let interest rate rise until they feel that growth is stable enough to withstand that rise. If a correction were to happen, SCI feel that their global managed volatility product and also their short duration product would help protect return. Okay, so let's move on to Close Brothers. Close feel that certain sectors within developed market equities, such as telecoms and utilities, are now looking overvalued, and you will see secular rotation. They're positive on healthcare, seeing more M&A within the sector, so more corporate activity within the sector. Looking at income, Close have benefited from a more diverse asset exposure, with the infrastructure funds performing particularly well. Okay, so let's move on to Goldman Sachs. I'm going to start off with the Goldman Sachs Dynamic Fund. Looking at the economic and technical indicators that Goldman Sachs look at, they're seeing that they're positive, but they're not substantial. So for equities, both the economic and technical indicators, they are very positive in one way, but not strong enough for Goldman Sachs to look to make changes. Looking at the positioning, they're very overweight relative value, and that's been quite positive to performance within the portfolio. If we move on, if we look on at Income Builder next, Income Builder is yielding around about 4.3%. That yield's paid monthly. It's a very high level of income. Duration is short for the portfolio, and that's because they're nervous around interest rate risk. And Goldman Sachs feel that they offer more of a concentrated security selection compared to other funds. So that means that they have the ability to potentially avoid dividend cuts that funds that buy more of the market will end up receiving. Okay, so next let's move on to Threadneedle. So Threadneedle, normally the asset allocation is around 80% UK equities, 20% bonds. That's actually moved slightly, so it's now around about 74% equities, 22% bonds, and the excess in cash. And the reason why that's happened, it's not a position change by Threadneedle, it's because bond markets have seen such incredible performance. Threadneedle are looking to move that back to the 80-20 asset allocation spread, and they're doing that as money comes in. Starting off with UK equities, they're topping up on names that they already hold, but they're not looking towards any new names at the moment. So they're just looking for any falls in markets to top up holdings. Looking at dividend growth, Threadneedle are hoping for around about 3% dividend growth this year. Okay. So next, let's move on to 7IM. So 7IM have been tactically adjusting their portfolios, switching out of an overweight position in European equities and increasing US equities, moving equity positions to growth areas, away from Europe and away from any sort of potential Brexit problems that we might see within Europe. In addition, they've been cutting their foreign currency exposure, closing out the US dollar and yen positions following strong rallies post-Brexit. Lastly, we have Allianz, and over the summer with volatility falling, Allianz have been overweight equity. However, they now believe that volatility could spike upwards. Therefore, they've been reducing down their overall equity position. Separately to this, Allianz believe that the emerging market indicators look weak. Therefore, they've reduced down their positioning within this area. Okay, so that's everything from me. I'd like to thank you all for listening, and I will see you next month. Thank you.